Hey guys, good afternoon. Thank you for joining in. So we have Dr. Ajay Mittal, Ajay Patil with us. So who is going to be talking about understanding a equity scheme fact sheet today. So Dr. Ajay Mittal is an industry. Ajay Patil is an industry veteran with over 19 years of experience working with companies like Jindal Group, Indian Express, Bombay Stock Exchange, Aditya Birla Group, among others. He has done his PhD in financial economics, MBA in finance, Master of Commerce and Economics, along with Chartered Wealth Manager. So he also has a Claritas investment certificate from the CFA Institute in US and has also cleared the CFP. He's also into financial training since the last 15 years and is a visiting faculty for various management colleges across India. So Ajay, start the session, please.
Yeah, thank you, Puneet. So, in today's session, we are going to discuss how to read fact sheet and how to read fact sheet for the equity mutual funds or equity funds. So, it is very important to understand that yes, why we need to analyze the fact sheet and why it is important to have an analysis of the fact sheet and all. So, I will just take the simple example in this. When we are plucking a flower, we are really choosy in about the color, size, and all those things, type of the flowers and all. So in the same way, when we are investing our money or hard-earned money, rather say, so uh, we are also very choosy in that. So when we are investing our money, we should have to keep one thing in mind, that yes, we should get into the details where we are investing our money, and we should get into the details. Yes, why should I invest my money, hard earned money, in this particular instrument? And it is very important and very relevant when you are investing in mutual fund or about to start investing in mutual fund, to know about the fact sheet. So fact sheet is a very important document to understand. So to start with, like, many of the things are there in the fact sheet which is very important, like to name a few: scheme name, nature of scheme, scheme objectives, riskometer and scheme suitability. The fifth one is inception date, like benchmark, fund managers, the experience of the fund manager, about the fund manager. Then the next part is investment style, the portfolio holdings, what type of portfolio holdings the fund is having. Then portfolio turnover, what is portfolio turnover, what is the relevance of portfolio turnover. Then about what is the standard deviation of the fund, and what are the Sharpe ratio, and what are the expense ratio of the fund, what is the exit load of the fund. So all those things we are going to discuss it in this webinar, and in detail. And these are near about 15 parameters on which the fact sheet analysis will be done. And specifically, I'm going to talk about equity mutual fund analysis or equity fund analysis, how to analyze the fact sheet or how to analyze the equity fund on the basis of these 15 parameters. So to start with, like, scheme name. So when we are talking about the scheme name, this is the quickest view on what the fund is. Like if I will talk about, for example, SBI Blue Chip, or if I'm talking about the name SBI Blue Chip, obviously in my mind it is coming that yes, Blue Chip is the fund. SBI Blue Chip is the fund in which the investment is being done in the blue chip companies. And if I will talk about SBI mid cap, SBI multi cap, SBI small and mid cap, so many of the funds are there. Through scheme name itself, you would be able to understand that yes, in which kind of investment, what kind of investment the scheme is doing. Like SBI Blue Chip, on the top 100 companies or top 100 blue chip companies, the investment is being made. So mid cap fund, SBI mid cap fund, in mid cap companies the investment is generally being made. Like multi cap, in multi cap generally being made in small cap, mid cap, and large cap, all three caps, on the basis of the market scenarios. And like another example is SBI FMCG fund. Okay, like in SBI FMCG fund, only the companies related to FMCG sector, fast moving consumer goods sector, there the investment is being made. So scheme name itself is telling you that what kind of investment, or what kind of investment where we are making it. So that is called, the first one is the scheme name. Then we have nature of scheme, what kind of scheme it is. Like nature of scheme, whether it is closed ended or open ended. Sometimes people are getting confused, what is open ended, what is closed ended. In open ended, in a very layman language, after the new fund offering is the terminology whenever the fund is coming for the with the issue first time, that is called new fund offering. And in open ended, you can buy and sell units of the funds on any business day and after the NFO. But in the closed ended, you cannot buy units other than NFO. So that is the basic difference between these two. So nature of the scheme, whether it is open ended or closed ended. Then the plans and options, like growth options are plans available, it's a regular or direct. So in options we have growth option or dividend option. uh, in growth option and dividend option, in terms of returns, or in terms of getting a uh, percentage returns, it is not making much of a difference. But the working or getting a investment done through these options is totally different. Like in the growth option, how it is working, in the growth option your NAV is increasing. Okay. And in the dividend option, you're getting a dividend as and when the fund is having a surplus. So in the corpus, if you're having if the fund house is having a surplus, if they are thinking that yes, the dividend is being should be given, the dividend will be distributed. In growth option and dividend option is this: in growth option you are getting a higher benefit of compounding, because you are not getting a money in the way of dividend, and your money is getting compounded. And the second aspect of dividend option is this: like if the people who are retirees, they can opt for dividend option. And as and when the dividend will be declared, they will get the dividend, or retirees people will get a dividend. And regular and direct, I will talk on the next slide, on the 13th or 14th slide. And now scheme objective. What is the scheme objective? So scheme objective is telling you what the scheme intends to do. So what the scheme intends to do, and majority of the equity funds have broad an objective of long-term growth in capital. So if you'll see, a majority of the equity funds across the category, generally they are having a broad objective of long-term growth in capital. And like I'm taking an example of SBI Blue Chip Fund. So SBI Blue Chip Fund, their scheme objective is this: to provide investors with opportunities for long-term growth in capital through an active management of investments in a diversified basket of equity stock of companies whose market capitalization is at least equal to or more than the least market capitalized stocks of S&P BSE 100 index. Now, with this, I will also define you the difference between the mid cap, large cap, and small cap, how they are different, and what sort of things are making them different. So, large cap, mid cap, and small cap is like according to market definitions, above 10 crore is generally being taken into consideration as a large cap, and below 10 to 2 crore to 10 crore it is coming as a mid cap, and below 2 crore it is coming as a small cap. So this is the definition, generally broad definition by the exchanges, and time to time it is getting changed. But every fund house is having their own definition of market capitalization: mid cap, small cap, and large cap. And market capitalization is generally being taken into consideration from different aspects. And market cap is nothing, it is like how much number of stocks the company is having and multiplied by its price, it is coming as a market cap. So on the basis of that market cap, the demarcation is being done. Then the fourth one is Riskometer and scheme suitability. And a Riskometer, as you can see on the slide, that there are five different aspects of Riskometer is there: low, moderately low, moderate, moderately high, and high. And as we are talking about the equity funds generally hover around moderately high and high. And totally it should totally be depend on the goals also of the persons when they are investing in the equity funds. Then as like SBI blue chip, I'm talking about as an example. SBI blue chip categorized in moderately high risk profile, scheme suitability, what kind of investor the scheme is meant for. So scheme suitability, it's like what kind of investors can invest in this particular type of fund. And if the person who wants to take a moderately high risk, if suppose the person is having a horizon of 20 years or 15 years, the person can invest in equity with a high kind of risk, okay, or moderately high kind of risk. So it's totally depend on the risk taking capacity as well as the goal of the person. Like this is SBI blue chip, long-term capital appreciation, investment in equity shares of companies whose market capitalization is at least equal to or more than the least market capitalized of S&P BSE 100 index. So this is about a Riskometer and scheme suitability. Now the fifth one is inception date. So inception date is basically it tells you the age of the scheme. And age of the scheme is what, since when the scheme is being started. And date scheme started its investment activity. The inception date is the date in which the scheme started its investment activity, so that date is called an inception date. And it is a very important, it gives you an idea that how long the scheme is in existence. And generally what is happening, the longer the existence of the scheme is there, the longer the experience of the scheme in the market would be there, and longer gyrations the schemes or the particular category has seen it. So higher age means longer track record and more experience under the belt. So covering various bulls and bear phases of the market. So like a market is having two types of phases, or generally three types of phases. Generally people are saying bull phase, bear phase, and consolidation phase. So bull and bear phases, the more bull and bear phases any fund is seeing, the more experience the fund would be having. Then date of allotment is this is about SBI blue chip. So date of allotment of SBI blue chip is 14th February 2006. So it's near about 11-year-old fund. So it gives you an idea that yes, what kind of fund it is. Then the next slide is related to benchmark. Benchmark is very important. Okay, how it works. So like it is called a point of reference. And if you are running, how would you be able to come to know whether you are running slow or fast? So that is called benchmark. If you are running along with your friend, so then you would be able to make it out whether you are running slow or fast. So it is like point of reference in this case is your friend. So in the case of the any scheme like blue chip is having a benchmark of S&P BSE 100 index. So what does it mean? It means that yes, if tomorrow SBI blue chip is giving a return of 10%, what should I do? How should I compare it? So I can compare it with S&P BSE 100 index. If S&P BSE 100 index is giving higher return than blue chip, it means there is some problem in my portfolio. Or if blue chip is giving higher return and then S&P BSE 100 index, it means I'm beating the benchmark. So and creating an alpha. So alpha, what is alpha and all that I will just let you know. And so benchmark is very important. Every scheme is having a benchmark. Since 2012, SEBI, Securities and Exchange Board of India, has made it mandatory for fund houses to declare a benchmark index for each and every fund. So a benchmark is like for blue chip, it is S&P BSE 100 index. So whatever the top 100 companies included in the BSE 100 index is there, and as a benchmark for blue chip. Now, the seventh one is the fund manager. Like if you'll see, majority of the fund houses these days are governed by processes and not on individual whims. So, but even then, the role of the fund manager, the strategy of the fund manager plays a very, very important role. Now, it is like a good fund manager helps to create a good strategy that can deliver better risk adjusted returns for the funds within the mandate. So fund manager role is also important, like in creating a strategy to beat the benchmark, to get the better returns, to create the better processes. And that is why the fund manager is a very important, plays a very, very important role in making a processes. Then the next one is, like in the case of the blue chip, the fund manager is Sohini Adnani, managing since September 2010, and total experience is over 22 years. And like it gives you an idea that long how longer the fund manager is in the industry, and how long the fund manager is managing the particular fund. Then the AUM as on April 28, 2017, AUM also gives you an idea that yes, it is how big the size of the particular fund is. Like in the case of the SBI blue chip fund, so as on April 28, 2017, it is 13,339.95 crores. So so one way, some people are saying no, the size is so big, and some people are saying the size is so big, it means the more people are relying on this particular fund, the more people are investing in this fund. Now, then SIP and lump sum investments, and like SIP, you can invest. This is all also the information which is available on the fact sheet. Uh, like weekly, monthly, quarterly SIP you can do, and the minimum 1,000 rupees, and in multiples of rupee one thereafter, for a minimum of 6 installments, near about 6,000 per annum criteria. And in the monthly also it is the same, and in quarterly minimum 1,500, and in multiples of one thereafter, on for minimum of 1 year. And for lump sum, the minimum investment is 5,000 in multiples of rupees 1. And if you are doing after lump sum, the additional investment 1,000 minimum in multiples of rupees 1. So uh, this is the snapshot of SBI blue chip fact sheet. Then portfolio strategy in fund fact sheet is like investment style. What sort of investment style, how the fund will go about identifying its universe and making it a stock selection, how the fund is selecting the stocks, how, what is the universe of the fund is, so what is the diversification strategy of the fund is. So investment style gives you an idea what kind of investment style the fund is having. Then with this, I'm also telling you about what kind of asset allocation in the equity the fund is doing. Like large cap 68.6%, mid cap 15.7%, and futures 8.9%, cash 6.8%. So like this is the kind of asset allocation generally being done. So might be different fund would be having the fund like multi cap would be having more into mid cap, less in large cap, and little bit higher in small cap. Asset allocation is also dependent on the type of fund, the investment style of the fund. Then another aspect is portfolio holdings. Portfolio holding plays a very, very important role. So portfolio holding, what sort of stocks the fund is having, what sort of sectors where the fund is investing. So in the fact sheet, in some of the fact sheet, you will find it out which are the top 10 stocks. In some of the fact sheet, you will also find it out what are the top 10 sectors. So on like on different on websites of different mutual funds also, you can easily find out the full portfolio of the schemes on a monthly basis. So you can easily find it out. If in SBI blue chip fund, how many stocks are there, like in equity, near about, it comprises of 86%, near about 86%, and 51 stocks are there in this. uh, Top 10 sectors, the highest percentage of sectors and all that, like I will show it to you. You can see it over here. So this is HDFC Bank. So 8.34%. Only one stock is there which is having which is having more than 5% exposure in the stock. So HDFC Bank is there. But otherwise, all stocks are having uh, an exposure of less than 5%. So like HDFC Bank, L&T, Reliance Industries having 3.11%. And so these are some of the stocks. Then this is the another list. This is industry also, it is being given. So total 51 stocks are there in this, in the April fact sheet. Now, industry. So if you'll see the sector, so financial services is having 25.36% exposure, and automobile is having 11.56%, consumer goods 7.29%, 7.16 is energy, and 7.09 is pharma. So in fact sheet, it is giving you a broad idea about what kind of portfolio holdings in terms of sectors, in terms of stocks you would be having. Then portfolio classification by asset allocation. This is what, like mid cap, large cap, and small cap. How much percentage allocation is being done in which category or which cap. Then you are having portfolio turnover. So portfolio turnover is giving you an idea how often the fund make changes to its portfolio in terms of buying and selling stocks. Like, and some of the funds, the portfolio turnover is, in some of the funds the portfolio turnover is high, but as a general rule, the lesser is the better. So lower the portfolio turnover would be, the better it would be. The higher turnover means more expenses on the fund, and more expenses on the fund would means lesser would be the returns also. Then the next one is volatility measures. So which are the, what are the volatility measures and how it works, and standard deviation. So what is standard deviation, how it works? So standard deviation in statistics, generally we are reading it is deviation from the mean. So it means, like, if lot of deviation is there in your returns in the preceding years, like one year if you, the fund is giving 20%, second year it is giving minus 20%, third year it is giving 50%, fourth year it is giving 10%, and the fifth year it is giving 0%. Just for the sake of the example, I'm just defining it. And like, so much of deviation is there in the return, which is like not good. The consistency in the return of the fund is taken into consideration as a better thing. And more the deviation, more volatile the fund is, and lesser the deviation, lesser volatile the fund is. So but some of the funds are there where the deviation is deviation plays an important role. But if you will see in the equity category, standard deviation would, if you are holding the stocks or holding the funds for a longer period of time, the deviation always uh, squeezed down, or down in the sense is settled. Now another option is another volatility measure is Sharpe ratio, and it's a risk adjusted return ratio, or we can say risk to reward ratio. And it is giving you an idea against 1 rupee of risk how much return you are getting. So it is we are saying a risk to reward ratio. So if you are taking 1 rupee of risk, how much return you are getting. So generally when we are saying this, we it is related to the category, and the formula by which we are calculating it, it's a return of a portfolio. uh, we deduct the risk free return from that, and we calculate the divided by the standard deviation, we will be able to come to know that what is the Sharpe ratio of this. So Sharpe ratio is like rule, the higher the Sharpe ratio, the better it is. So if the Sharpe ratio is 1, or if the Sharpe ratio is zero point 0.5, or if the Sharpe ratio is say 2, so it means against 1 rupee of risk you are getting 2 rupees. So higher the Sharpe ratio, the better it is. Then we have charges, expense ratio. Expense ratio is very important from the perspective of the fund house, and fee charged for running the show. What sort of fee is generally being charged? Fee charged for investment management, sales and distribution cost, brokerages, custodians, and so on. So whatever the charges would be there. And like in case of direct plan expenses are always lower because they do not have sales and distribution cost. So expense ratio also plays an important role, and if lower the expenses ratio, the better it would be for the scheme. If higher the expenses ratio would be there, it is not taken into consideration as a good thing. Then we have exit load. Exit load is basically, it gives you an idea that if somebody wants to redeem early, okay, if somebody decide to redeem before specified time, you may have to, or the person have to bear a charge that is called an exit load. And exit load are typically created to prevent early redemptions by investors. So that's why because sometimes what is happening, the people are coming in and going out if the exit load is not there. So, and in majority of the cases, the exit load for some of the funds in equity, it is 6 months. For some of the funds it is 1 year. So generally it is, in majority of the cases, it is not beyond, for open end it is not beyond 1 year. So like for SBI blue chip, for exit within 1 year from the date of allotment, 1% for exit, and after 1 year from the date of allotment it is nil. And in majority of the in mutual fund there is no entry load.
Okay. Thank you, Ajay, for that illuminating
Yeah.
explanation. And I hope everybody
Thank
has
you.
something to take away from the session. So, viewers, now that you know how to evaluate a fact sheet, so head on to coin.zerodha.com, search for your fund, evaluate, and get started in investing in mutual funds. Thank you, everybody, for joining.